Hello everyone, my name is Raymond and my colleagues are Michael, Melissa, Nikki, and Erica. We're here today to provide your company with our recommendations to achieve your goals. Now we recognize that the company has two essential goals: a growth target exceeding $500 million in revenue by 2019 and to maximize shareholder value. Now we recognize the following options that are available to meet your goals. You can develop genset locomotive, either in-house or through a joint venture with Energy Locomotive. You can acquire TB mining, or you can expand geographically into Peru. Now I'd like to provide a brief summary of our analysis of these options. So your first option is to develop genset locomotive. Under this choice, you can develop it in-house or through a joint venture. The main benefit with the in-house option is higher cash flows. Now on the other hand, the joint venture option provides a higher sales dollar amount. The risks will also be lower when partnering with EL since they already have a presence in the green locomotive market. Moving on to the next option, you can acquire TB mining. Compared to all other options, acquiring TBM provides the highest gross sales. The products they offer will also complement your mining sector products. Lastly, mining is a secure industry, and over the next decade, demand is expected to surpass supply. And your last option is to expand into Peru. This option would help the company meet its sales target. However, the cash flows are lower, and given the volatile political environments in South America, it is definitely the riskiest option. Now the question is, given all these options available to AI, which option should the company choose? To provide our recommendation, I'd like to pass it over to Melissa.
I will now be discussing our overall recommendation. We recommend that Ardnt pursues the JV genset and purchases TBM. The advantages of this are that their target of $500 million by 2019 will be met, the return on assets goal of 10% will be met, and their current ratio will meet the bank covenants. In addition, they'll also be able to minimize the environmental impact of greenhouse gases. We do not recommend that they develop the genset locomotive in-house and do not set up operations in Peru. Even though both alternatives are profitable, it increases their risk exposure, and there are poor land distribution channels in Peru that are subject to guerrilla attacks and railways that are prone to landslides. To fund this, we recommend that Ardnt uses their $50 million in debt financing through the bank. $9 million can be used for the joint venture, $11 million can be used to acquire TBM, and any remaining funds can be used to be spent on other purchases such as equipment. We feel that the revised mission statement should read, Ardnt Industries is committed to manufacturing innovative, quality equipment and systems through its diverse subsidiaries, Ardnt Agricultural Products Ltd., Ardnt Engineering Products Ltd., and Ardnt Railroad Products Ltd., and for the added value to shareholders. I will now pass it on to Nikki to discuss the implementation strategies.
Uses ASPE. Once the acquisition has taken place, TB statements will need to be converted to ASPE for the presentation of consolidated statements. The IFRS statement will remain for TB. This will add considerable cost as the statement will need to be converted. As well, there are also many inherent risks associated with the accuracy and of the conversion itself. In terms of union contracts, a meeting with the union and a review of contracts of any contentious issues should be arranged. A discussion between the contract negotiator and the manager team should be arranged to discuss any issues of the contract. For foreign exchange, forward contract, there's currently $750,000 outstanding gain on the foreign exchange contract. It needs to be established if there are any expectations that AI will collect this amount in the realizable future. Now I will move on to operational issues. In order to successfully implement for the strategic plan, AI must first address several operational issues. First one is succession planning. AI's ownership and management have raised the need for planning for the succession of the business, and they have expressed specific interest in keeping ownership of the business in the family and passing the ownership from generation to generation. The expressed desire to transfer intergenerationally at less than fair market value must be addressed. The tax implications are that the transfer is deemed by the ITA to have sold their shares at their fair market value, notwithstanding that they receive less than the amount from the transferee. The adoption does result in double taxation. One possibility to avoid this unnecessary taxation is to use an estate freeze. That is used in intergenerationally transfers of private held equity or private held enterprises in Canada. An estate freeze is usually made up of a freeze in value of shareholdings of an existing shareholders through an exchange of common shares for preferred shares of equal value. Shareholders agreement. Shareholders agreement. The following are recommended changes to the existing agreement that should go through. In terms of paragraph 1A, change original 25% structure to direct family unit. 1B, change the sentence originating 25% ownership family to direct family unit. Paragraph 3A, change the paragraph to read, current board of director will provide a suggested list of members that the shareholders will vote on, whereby each current member of the board has the right to provide a single name. And the last change that will be provided, or that will be required, will be change the sentence at least 80% of the owners to more than 2/3 of shareholders' votes. Now I will address tax issues. All 4 entities of AAI are subject to the corporate provision under the rules as set out by Canada Revenue Agency through the Income Tax Act. Provided below, I have provided some of the issues that need to be addressed. In terms of renewable resources, AAI is involved in developing technology with respect to renewable resources. The Income Tax Act provides incentives in forms of accelerated capital cost allowance. It is recommended that AI investigates the possibilities of accelerated CCA within their entities. For warranty costs are deductible for tax purposes when cost of warranty service is incurred. The accounting provision for future warranty expenses is not deductible for tax purposes. It is recommended as a part of the warranty audit being proposed, the expense of warranty services be investigated to ensure that only actual warranty services are expensed. Lastly, I'd like to talk about inventory. AI uses the lower of WACC and NRV for its inventory accounting for raw materials. The Income Tax Act does not allow WACC, it mandates FIFO. Therefore, any material differences between WACC and FIFO must be adjusted in tax filings. Lawsuits related to product liability claims are deductible for tax services at the time that the judgment is issued by the court and at the time a legal settlement is made with the plaintiff. Now I will pass you on to Mike, who will take things further.
Thanks, Nikki. Now moving on to international tax issues. AI has inventory on consignment that is held in offshore locations. Because of this, AI will be subject to the tax laws in these different jurisdictions. Now, Canada has different tax treaties with numerous countries around the world. So depending on there's a tax treaty in these countries, that tax treaty will apply. If not, if no tax treaty doesn't exist, then AI will be subject to the jurisdiction and the laws within that particular country. Furthermore, another international tax issue is the consequences of employees transferring to the USA in regards to the joint venture agreement. There will be a couple of tax consequences in terms of people becoming permanent residents, things that the company will have to deal with. Moving on next is going to be the acquisition. So again, tax impacts regarding the acquisition is that you're going to have the acquisition occurring at $10 million, and there's going to be the difference between the shares at ACV and the acquisition price. Now, the ACV can only be adjusted up by so much only on non-depreciable property. That is specifically the land. This can be bumped up to its fair market value of 1.5, and its current ACV is at $750,000. Furthermore, there's going to be anticipated acquisition costs with the acquisition, and these are not deductible to the income for AI. Next, we have tax issues regarding the joint venture. So with the joint venture, there are tax advantages for a CCPC of not AI, but in the joint venture company that AI would be joint venturing with. So, such advantages would be the small business deduction of a CCPC, which lowers the tax rate, as well as enhanced CCA rates and shred rates that, again, are more beneficial for going into the joint venture and having a CCPC versus a non-CCPC. The one big issue about classifying it as a CCPC will be its association with AI. This is what CRA deems if AI has a majority shareholder, which would be 50% or more, or if AI has significant influence. This gives an association between the two and is something that will have to be further explored through the joint venture. And now we have legal issues. So there's a customer who is suing AI for $3.5 million over an issue that had begun 20 years ago. We have a couple of options with this legal issue. First, you have the option to settle. They've given you the option to pay them $2.5 million. However, you will get to keep the business relationship with this customer for going down this route. The other option would be going to court and trying to win the battle with them. However, this will incur $500,000 in legal fees. There's a 50-50 chance of you winning or losing, and a loss in the suit, you'll also have to pay the legal fees for the customer as well. So there's a lot to consider between the two options. Our recommendation, based on what you as the owner feels as most important, is keeping the business relationship. Therefore, we're going to go with option 1 and settling, because this allows you to keep the business relationship with the customer, and you don't have to essentially flip a coin of going to court and either having a big win or a big loss and having to pay out a lot of money. And now I'll be passing it on to Erica.
Thanks, Mike. To continue with the implementation plan, I'd like to start with talking about CRM system. So we believe that AI will benefit from implementing a centralized information system to understand and promote customer lifetime value. We recommend that AI should begin implementation of the CRM system at the start of 2016 because it will take 1 full year to fully integrate. We also note that a more complex system may be necessitated because AI has a broad international customer base across all of its divisions. In terms of share valuation, to arrive at a fair price, 2 different valuation methods were used, which are the discounted cash flow approach and the dividend discount model. Both approaches were used, arriving at a share price of $180 per share, and this price assumes a 1,000 to 1 share split of the original 1,000 shares, resulting in 1 million shares outstanding. So next up is quality control issues. So we noted that while EP has chosen to adopt Six Sigma principles, RP and EP have chosen not to. So EP's choice to only test at 50% completion may be the cause of increased warranty provisions. And as such, we recommend that EP should budget an additional 1% of sales to increase quality control initiatives, and these costs will be mitigated by the expected decrease in warranty provisions by 1%. Next, I'd like to talk about dealership issues. So we believe that establishing an audit function at a cost of $600,000 a year is needed to ensure that dealers are charging proper warranty expenses to AP. And with respect to the dealership that was in breach of contract by selling competitive products, we recommend that AI sever all ties and pursue legal action. Finally, I'd like to touch upon dividends. So we noted a big issue where the board of directors declared and approved a $10 million dividend prior to the financial statements being finalized. So the implication of this is that the dividend payment could be based on false information, and items payable could cause strain on cash flow. As such, going forward, we recommend a policy should be established to ensure that no dividends are declared or paid until the financial statements have been finalized and a cash flow budget established. And to wrap things up, we have evaluated the major business opportunities available to AI, and we recommend that AI pursue a joint venture with EL and acquire TB mining. And to fund these initiatives, AI should acquire a $20 million bank loan. So on behalf of myself and my team, we thank you for listening, and we welcome any questions.